Let's talk money.
Welcome back. You're with us on the Women's Day special edition of Let's Talk Money, and we are answering all the questions which you ladies are sending us. So, Swarup and Jyotsna, I have two more emails that I'd like to quickly include on the show. The first one comes in from Meena Shah. Now, Meena Shah is 53 years old, and she wants to know how she should go about investing for retirement. She already has a lump sum corpus of around 50 lakh rupees, and now she wants to know if she should be in mutual funds, and specifically what should she do about debt. Should she also invest in debt funds? That's one question. That's Ms. Shah's question. And then Janali has also written in to us, and Janali is saying that she already has investments in PPF, EPF and NPS. Should she do anything further beyond this for the debt part of her portfolio? So if you could just sort of talk about this and throw in a word on debt as well. Swarup?
Yes, Surabhi. To both the women, I'd like to make one submission that, the fundamental rule of investing is all money should beat inflation. One has to calculate whether that 53 lakhs is beating inflation. If not, then it is not conserving capital already. One is to move to investment instruments which do that, and I would encourage looking at the plethora of products we have across the risk profile on the debt mutual funds, open-ended, that would give them market-linked returns would be a better way of approaching it. But more important, since it's for 53 and would probably have to plan for 40 more years, some part should go into growth assets definitely, because as you start getting older, your money also needs to grow. It need not grow in debt. So she'll have to park a little bit of it in growth assets, maybe into equity, is something which she seriously needs to think and grow the money to both of them. If the second lady is investing in NPS across, these are good, excellent yielding instruments, but when you look at retirement, some part of it has to shift to growth assets. At this moment, the growth assets is definitely equity in India.
Jyotsna, come in on this, because again, traditional wisdom told us that as you're approaching retirement, reduce your risk completely and largely be in fixed income. That the age rule which we had on investing. But now, like what you're saying, what Swarup is saying, that we're living longer. Sure. Life is more complex. Inflation is higher. Life expenses are higher. So then for people who are approaching their late 50s zone, what is the advice in terms of just the asset allocation mix?
So the asset allocation mix has to be as per their risk profile. This might sound repetitive, but it's really important to understand that. But I'd add another element to it, and that is of liquidity. Because if they're coming closer to retirement, what they will need is some sort of an annuitized cash flow. The frequency, of course, can be decided, and therefore they should not be getting into any sort of products, etc., which have very long lock-ins, etc. And I think that's a trap a lot of people tend to fall into. The lure of higher returns, etc., very often tends to do that. But I would say keep liquidity in mind. Other than that, whether it's fixed income, which is often seen as the safety part, if I may say so, equities, which is the growth engine. And then, of course, these days you have alternates as an asset class, which sort of adds a little bit of spice to the portfolio. I think there's a place for each one of these in everyone's portfolio, but what percentages, etc., is really up to the individual, and he or she has to take that call for themselves. It's really important.
Absolutely. I think we've discussed a lot of very important nuggets on the show. So for the benefit of our viewers, I want your help in recapping everything in bite-sized portions, right? So Swarup, why don't you talk about the basics of personal finance when it comes to women? And then I'll ask for the summary of the investing tips from Jyotsna in just a bit. But the basics.
I think the basics of personal finance remain the same for men and women, but when it comes to women, three things are very important. Since they live longer, their retirement planning has to be very serious and accounted for for a longer piece of longevity of life. Second, most of the times in families, the education part of the children comes on women. The education inflation is serious. You cannot imagine the amount of conversations Jyotsna and I have had on the kids' education. The money needed will be phenomenally higher than what you put in mind. So keep that in mind. The third part, because biologically we are different, the need for medical emergencies are more for women. So the medical insurance has to be clocked in very early, and it has to be a fairly larger amount, because if you go to a hospital, the first question is not what is your disease, is whether you have an insurance or not. Yeah. So these three are different for women and very important to be kept in mind in all plans.
Jyotsna, now investments, summarize it for us in terms of everything that we women must keep in mind.
Again, I would say just I'm a huge believer in KISS, and by that I mean just keep it simple and stupid. Vanilla is good. It's a popular flavor for all the right sets of reasons. You don't have to get swayed by exotics. Keeping that in mind, I'd again sort of say that you have clarity on your goals, know your risk appetite, have an asset allocation and a portfolio approach, but even more importantly, have the discipline to maintain the asset allocation.
It's been fantastic speaking to both of you. Thank you very much for joining in and being with us on this really important episode of Let's Talk Money. Great to have you on today.
Thanks,
Thank you
Ruby.
so much.
Thanks.
Thank you, viewers, for being with us. Remember, this is your show. You ask, we answer. So keep those queries coming in on our social media handles as well as our email ID. See you on the show next week.
Let's Talk Money